Hello traders, you're welcome back to the Forex Geek channel. In this video, we are just going to be diving deep into one of the most powerful and widely used strategies in trading, and that is the moving average crossover. Okay, this strategy is perfect for traders in Forex, crypto, and the stock market. And in this video, we are going to break it down step by step so you can start using it right away. By the end of this video, you'll understand how moving averages work, what a crossover signal means, and how you can incorporate this simple yet effective strategy into your trading plan, okay? So let us get started. Before we jump in, make sure to hit that like button and subscribe for more in-depth trading tutorials, okay? Let us start with the basics. Now, the moving average crossover strategy occurs when a short-term moving average crosses over a long-term moving average. For the purpose of this video, we are going to be using the 50 EMA and the 200 EMA. All right. Okay. So these two moving averages are usually simple moving average or exponential moving average. Okay. The common periods are usually the 50 period and 200 period. So when the shorter moving average crosses above the longer moving average, this is known as a bullish crossover, which signals the potential for an upward price movement. Okay. On the other hand, when the shorter term moving average crosses below the longer term moving average, this is called a bearish crossover, indicating that the market could be moving downward. Now, understanding this basic crossover concept is the first step to mastering this strategy. Now, let us talk about setting up your charts. Okay. To trade the moving average crossover, you'll need to add two moving averages to your trading platform. The first is the short-term moving average, which is typically the 50 SMA or the 50 EMA. All right, but in this case, I'm using the 50 EMA. Then the second is the long-term moving average, which is usually the 200 SMA or the 200 EMA. But in this case, I'm using the 200 EMA. Okay, most charting platforms like TradingView, MetaTrader 4 or 5, or any other platform you are using should have these indicators built in. Okay, simply search for the moving average and just adjust the period to the ones that we discussed. Now you should have a chart with two lines, one representing the short-term moving average and the other for the long-term moving average. Now let's move on to understanding what these crossovers mean. Okay, so when do you actually trade? Here's how you can interpret the signals. For a bullish crossover, when the short-term moving average crosses above the long-term moving average, this suggests that the trend is shifting upwards. In simple terms, the market is going bullish, right? This could be a signal to enter a buy trade. A good rule of thumb is to wait for confirmation, such as a few candles closing above, the long-term moving average, all right, or a price pullback before entering, because patience is key, all right. Then for a bearish crossover, when the short-term moving average crosses below the longer-term moving average, it's a bearish signal indicating a potential downtrend. In this case, you might consider entering a sell position. Okay, now let's talk about time frames. Now, the moving average crossover strategy works well across multiple time frames. All right, but it is important to choose one that fits your trading style. Okay, if you are a day trader, you might want to stick to short time frames like the 5 minute, the 15 minute, you can use the 5-minute chart or the 15-minute chart or the 1 hour chart. All right, then for swing traders, you might want to focus on the 4-hour chart or the daily chart. All right, because they are more reliable, right? Then while long-term traders might focus on the weekly chart or the monthly chart, right? The weekly chart or the monthly chart. Okay, that is for spotting larger trends, right? For spotting larger trends. Now, the key here is to match your time frame. The key here is to match your time frame with your trading style and your goals. Using multiple time frames can also help you filter out false signals. All right. So while the moving average crossover is a powerful strategy on its own, you can enhance its effectiveness by combining it with other indicators. A common combination is to use the RSI to confirm the signals. For example, if you get a bullish crossover on the moving averages, but RSI is indicating an overbought condition, you might want to wait for a clever signal or pullback before entering. Okay. On the other hand, if the RSI is showing oversold conditions and you get a bullish crossover, that could be a strong confirmation to enter a buy trade. Okay. But if you get the RSI is in the overbought territory and you get a sell signal, bearish crossover, it could be a sign to enter a sell trade. Okay. Now here are some best practices to keep in mind when trading the moving average crossover strategy. First of all, do not rely on crossovers alone. Now, as with any strategy, you should never rely on moving average crossovers alone to make your decisions. Combine them with other technical indicators and chart patterns. And also look for confirmations. It is very necessary, essentially necessary to get confirmations. Okay? You wait for additional confirmations like price action, volume, or candlestick patterns before entering a trade. Okay? Finally, use proper risk management. Now, even though the moving average crossover strategy can be highly effective, no strategy is foolproof. Okay? So, always use stop loss orders to manage your risk and to protect your capital. It is very necessary. Right? You might have an effective strategy, a profitable strategy, but if you do not know how to manage your risk, you might still be losing a lot of money. So risk management is necessary. It is paramount. Okay. Ensure that you have good risk to reward ratios. Do not trade with an amount that you cannot afford to lose, and make sure that your risk to reward ratio is favorable in the sense that the amount that you are making should always be more than the amount that you are risking. For example, you can use a risk to reward ratio of 1:2. If you are risking $1, your potential profit could be $2. That is times 2 of what you are risking. Okay, so that's just an example. Now, to wrap it up, the moving average crossover strategy is actually one of the effective strategies that we have out there, and it's also easy to understand. So even complete beginners in Forex can make use of this strategy. Okay, and it's not even only Forex where it's applicable. You can also use it in the crypto market and in the stock market, right? So by understanding the crossover signals and combining them with proper risk management and confirmation indicators, you can actually start using this strategy to make more informed trading decisions. Remember, always practice in a demo account before trading with real money. And if you're serious about taking your trading to the next level, hit that subscribe button, give this video a like, and let me know in the comments how you use the moving average crossover in your trading. Thank you for watching. Make sure you're subscribed, and I'll see you in the next video where we'll continue breaking down essential trading strategies. Happy trading.